Your bank just sent out a warning that most retirees are completely ignoring, and it could cost you everything you've worked your entire life to build. I'm not talking about some distant threat or theoretical risk. I'm talking about something happening right now, in real time, that's quietly eroding the purchasing power of every dollar sitting in your savings account, every certificate of deposit you thought was safe, every money market fund you believed would protect you. And the worst part? The very institutions you trusted to safeguard your wealth are the ones sounding the alarm, yet hardly anyone is paying attention. Let me paint you a picture of what's actually happening behind the scenes. While you've been told that your money is safe in FDIC-insured accounts, while financial advisors have been preaching the gospel of balanced portfolios and conservative bond allocations, something fundamental has shifted in the global financial system. And it's not just affecting your neighbor or some faceless statistic in a news report. It's affecting you right now, whether you realize it or not. Think about this for a moment. When was the last time you could walk into a grocery store and buy the same amount of food for the same money you spent 5 years ago? When was the last time your utility bills, your insurance premiums, your property taxes stayed flat or went down? They haven't. They've been climbing relentlessly, month after month, year after year. And here's the kicker. The money sitting in your bank account, the money you worked decades to accumulate, is losing value every single day. Not because you're spending it recklessly, not because you made bad investment decisions, but because the very nature of currency itself has changed and most people haven't caught on yet. Banks are required by law to send out certain disclosures, certain warnings about risks to your deposits. But they bury these warnings in dense legal language, in footnotes nobody reads, in quarterly statements that go straight into the recycling bin. Why? Because they don't want you to panic. They don't want you to understand the full scope of what's happening. But some banks, the ones paying attention to the bigger picture, have started issuing more direct warnings. Warnings about inflation risk. Warnings about currency devaluation. Warnings about the changing landscape of global finance. And these warnings aren't coming from fringe conspiracy theorists or doom and gloom bloggers. They're coming from the institutions that hold trillions of dollars in assets, the ones with entire departments dedicated to analyzing systemic risk. Here's what they're seeing that you need to understand. The traditional safe havens for retirees, the places where you were told to park your money and forget about it, are no longer safe. Not in the way they used to be. Savings accounts that once offered meaningful interest rates now pay you essentially nothing, while inflation eats away at your principal. Bonds that were supposed to provide steady income have become volatile and unpredictable. Even the stock market, which has been on a historic run, is showing signs of dangerous overvaluation and instability. The old playbook, the one that worked for your parents' generation, doesn't work anymore. The rules have changed, and if you're still playing by the old rules, you're going to lose. Now, before I go any further, I want you to check the description below this video. I've put together a free guide that shows you the exact strategies thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's completely free, no strings attached, and it could be the most important thing you read this year. Just click the link in the description and grab your copy while it's still available. Let me tell you about something that happened that most people missed entirely. Central banks around the world have been on an unprecedented gold buying spree. Not just any buying spree, the largest accumulation of physical gold in modern history. The People's Bank of China has been adding to its gold reserves month after month after month. The Central Bank of Russia, despite international sanctions and economic pressure, has been stockpiling gold at record levels. Poland, Hungary, Singapore, India, Turkey. The list goes on and on. These aren't small purchases. We're talking about hundreds of tons of physical gold being moved from Western vaults into Eastern central bank reserves. Why does this matter to you? Because central banks don't do anything without a reason. They have access to information and analysis that the general public never sees. They have economists and strategists whose entire job is to anticipate major shifts in the global financial system. And when you see this kind of coordinated behavior, when you see central banks from completely different political and economic systems all doing the same thing at the same time, you need to pay attention. They're not buying gold because they think it's a good investment. They're buying gold because they're preparing for something. They're hedging against a risk that they see coming but aren't publicly discussing. And it's not just central banks. Look at what the ultra-wealthy are doing. The billionaires, the family offices, the people who have access to the best financial advice money can buy. They're not keeping all their wealth in cash. They're not betting everything on the stock market. They're diversifying into hard assets. Real estate, yes, but also precious metals, gold and silver. Physical, tangible assets that have held value for thousands of years. Through every financial crisis, every currency collapse, every economic upheaval in human history. Here's something most people don't understand about the banking system. Your deposits, the money you think is sitting safely in your account, isn't actually there. Not in the way you imagine it. Banks operate on something called fractional reserve banking. They're only required to keep a small fraction of deposits on hand. The rest? They lend it out, invest it, use it to generate profits. This system works fine as long as everyone doesn't try to withdraw their money at the same time. But what happens when confidence in the system starts to crack? What happens when people start questioning whether their money is really safe? We saw a preview of this not too long ago. Remember Silicon Valley Bank? Remember the panic, the bank runs, the emergency interventions? That wasn't some isolated incident caused by mismanagement at one institution. That was a symptom of deeper structural problems in the banking system. Problems that haven't been fixed. Problems that have actually gotten worse. And the response from regulators and policymakers? More of the same policies that created the problems in the first place. More money printing. More debt. More kicking the can down the road. Let's talk about what's happening with the dollar itself. For decades, the US dollar has been the world's reserve currency. That meant that international trade was conducted in dollars, that foreign governments held dollars as reserves, that the dollar was essentially backed by the full faith and credit of the global economic system. But that's changing. Rapidly. Countries are starting to settle trade in their own currencies. They're creating alternative payment systems that bypass the dollar entirely. They're reducing their dollar reserves and increasing their holdings of other assets, gold primarily, but also other currencies, other commodities, anything that isn't tied to the fate of the US dollar. This isn't some theoretical future scenario. This is happening right now. Saudi Arabia, which for half a century has sold oil exclusively in dollars, is now accepting payment in other currencies. China and Russia are conducting massive trade deals in yuan and rubles. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on creating their own currency system to compete with the dollar. And every time another country moves away from the dollar, every time another trade deal is settled in a different currency, the demand for dollars decreases. And when demand decreases, value decreases. It's basic economics. Now, I know what some of you are thinking. You're thinking, but I don't trade internationally. I don't deal with foreign currencies. Why should I care about what's happening with the dollar on the global stage? Here's why. When the dollar loses value internationally, it loses purchasing power domestically. The things you buy, the goods and services you depend on, many of them are imported or depend on imported components. When the dollar weakens, those things get more expensive. Your grocery bill goes up. Your gas prices go up. Everything gets more expensive, and the money in your bank account buys less and less. And here's the really insidious part. The official inflation numbers, the ones the government reports, don't tell the whole story. They use something called hedonic adjustments and substitution effects to make inflation look lower than it actually is. They say, well, if steak gets too expensive, people will buy chicken instead, so we'll measure the price of chicken. They say, well, this computer is more powerful than last year's model, so even though it costs more, we'll adjust for the increased quality. These statistical tricks make the official numbers look better, but they don't change your lived reality. They don't change the fact that your money doesn't go as far as it used to. Let me tell you about something that happened in the 1970s that most people have forgotten. We had a period of stagflation, where inflation was running rampant while economic growth was stagnant. People who had saved their whole lives, who had done everything right, who had followed all the conventional financial advice, watched their purchasing power evaporate. Retirees on fixed incomes were devastated. The money they thought would last them through retirement suddenly wasn't enough. They had to go back to work, cut their standard of living, make painful choices they never thought they'd have to make. And you know what saved the people who saw it coming? the ones who had diversified into hard assets, the ones who had gold and silver. While everyone else was watching their savings lose value, these people had assets that were appreciating. Gold went from $35 an ounce at the beginning of the decade to over $800 an ounce by the end. Silver went from $1.50 to $50. The people who understood what was happening, who took action to protect themselves, not only preserved their wealth but actually increased it dramatically. We're seeing similar patterns now. The same warning signs, the same policy mistakes, the same denial from officials who insist everything is fine while the foundations crumble beneath us. And just like in the 70s, the people who are paying attention, who are taking action now, are going to be the ones who come out ahead. The question is, are you going to be one of them? Here's something else banks don't want you to know. The FDIC insurance that's supposed to protect your deposits? It's backed by a fund that has nowhere near enough money to cover a systemic banking crisis. The FDIC has about $120 billion in its insurance fund. Sounds like a lot, right? Until you realize that there are over $10 trillion in insured deposits in the United States. That's less than 1% coverage. If we have another wave of bank failures, if depositors start pulling their money out en masse, that insurance fund will be exhausted almost immediately. And then what? The government steps in with more printed money, more inflation, more devaluation of your savings. This is why smart money is moving into assets that can't be printed, that can't be devalued by government policy, that have intrinsic value independent of any financial system. Gold and silver have been money for 5,000 years. They've survived the fall of empires, the collapse of currencies, wars, depressions, every kind of economic catastrophe you can imagine. And they're still here, still valuable, still recognized as stores of wealth all over the world. Now, let me address something important. I'm not telling you to panic. I'm not telling you to pull all your money out of the bank tomorrow and bury gold bars in your backyard. What I am telling you is that you need to understand the risks you're facing and take reasonable steps to protect yourself. Diversification isn't just about having stocks and bonds. It's about having different types of assets that respond differently to different economic conditions. And in an environment where currency devaluation is a real and present danger, having some exposure to precious metals isn't radical or extreme. It's prudent. Think about it this way. If you have $100,000 in savings and inflation runs at 7% a year, which is lower than what we've seen recently, you're losing $7,000 in purchasing power every single year. After 10 years, your $100,000 will only buy what $60,000 buys today. You've lost 40% of your wealth without spending a dime, just by holding cash, just by doing what you were told was the safe, conservative thing to do. But if you had taken even a portion of that money and put it into gold or silver, you'd have an asset that historically has kept pace with or exceeded inflation. You'd have something that maintains its purchasing power over time. You'd have insurance against the exact scenario that's unfolding right now. And here's the beautiful part. You don't have to be right about the timing. You don't have to predict exactly when the next crisis hits. You just have to have your protection in place before it happens. Let me tell you about the mechanics of what's happening in the precious metals markets right now, because this is where things get really interesting. There's a massive disconnect between the paper price of gold and silver, the price you see quoted on financial news, and the physical market, where actual metal changes hands. The paper market is dominated by futures contracts, by derivatives, by financial instruments that represent gold and silver, but aren't actually backed by physical metal. It's a leveraged, speculative market where banks and hedge funds trade contracts back and forth, often with no intention of ever taking delivery of actual metal. But the physical market is different. In the physical market, people are buying actual gold and silver coins and bars. They're taking delivery. They're storing it. And the demand in the physical market has been absolutely exploding. Mints around the world are struggling to keep up with demand. Premiums over spot price, the amount you pay above the quoted price to actually get physical metal, have been elevated for months. Delivery times have been stretching out. These are all signs of a market under stress, a market where demand is outstripping supply. And here's what's really fascinating. Despite this massive physical demand, despite central banks buying at record levels, despite retail investors around the world accumulating metal, the paper price has been relatively contained. How is that possible? Because the paper market is so much larger than the physical market that it dominates price discovery. But that can't last forever. At some point, the disconnect becomes too large. At some point, people start demanding physical delivery of the contracts they hold. And when that happens, when the paper market has to actually produce the metal it claims to represent, that's when you get a price explosion. We've seen this before in other commodities. We saw it in nickel recently, where a short squeeze forced the London Metal Exchange to halt trading and cancel trades because the price moved so violently. We saw it in palladium, where physical shortages drove prices to record highs despite relatively modest paper market activity. And the same dynamics are building in gold and silver. The difference is, gold and silver are monetary metals. They're not just industrial commodities. They're alternatives to fiat currency. And when confidence in fiat currency starts to crack, the demand for monetary metals doesn't just increase linearly. It increases exponentially. Here's something most financial advisors won't tell you because they're not trained to think this way. The traditional portfolio allocation models, the ones that say you should have 60% stocks and 40% bonds, or whatever variation they're recommending, those models were developed in a specific economic environment, an environment of relatively stable currencies, relatively predictable inflation, relatively functional financial markets. But we're not in that environment anymore. The assumptions underlying those models no longer hold. And if you're still following advice based on outdated assumptions, you're taking risks you don't even realize you're taking. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how to maintain the tax advantages of your IRA while protecting yourself with precious metals. It's worth checking out if that's relevant to your situation. No obligation, just information you need to make informed decisions. Anyway, back to what's happening in the markets. Let's talk about silver for a minute, because silver is even more interesting than gold in some ways. Silver has this unique dual nature. It's a monetary metal, like gold, with thousands of years of history as money. But it's also an industrial metal, used in everything from solar panels to electronics to medical applications. And the industrial demand for silver is growing rapidly. The green energy transition, the electrification of vehicles, the expansion of 5G networks, all of these trends require massive amounts of silver. We're talking about structural, long-term demand growth that isn't going away. But here's the problem. Silver production has been relatively flat. The easy-to-mine deposits have already been exploited. New mines take years to develop and billions of dollars to bring online. And most silver production comes as a byproduct of mining other metals like copper or zinc, so you can't just ramp up silver production in response to higher prices the way you might with other commodities. Supply is constrained, demand is growing, and the above-ground inventories, the stockpiles that have built up over decades, are being drawn down. The silver market is much smaller than the gold market. The total value of all the silver in the world is a tiny fraction of the total value of all the gold, which means it doesn't take as much money flowing into silver to move the price dramatically. And when you combine growing industrial demand with increasing investment demand, with constrained supply, with a market that's already tight, you have the setup for a price move that could be absolutely explosive. We're not talking about modest gains. We're talking about the potential for silver to outperform almost every other asset class over the next few years. Now, I want to address something that I know some of you are thinking. You're thinking, but I've heard about gold and silver before. I've heard people predicting big price moves for years, and it hasn't happened. Why should I believe it's different this time? Fair question. And here's the answer. Timing markets is incredibly difficult. Nobody can tell you exactly when a major move is going to happen. But what we can do is look at the fundamentals, look at the setup, look at the conditions that historically have preceded major moves. And right now, those conditions are more extreme than they've been in decades. The debt levels are higher. The money printing is more aggressive. The geopolitical tensions are more severe. The loss of confidence in institutions is more widespread. The technical setups in the charts are more bullish. The physical demand is stronger. The supply constraints are tighter. Every single factor that drives precious metals prices higher is either in place or getting stronger. And yes, it's possible that prices could stay suppressed for a while longer. It's possible that the powers that be can keep the lid on for another year or two. But the longer they suppress prices, the more explosive the eventual move will be, because the underlying imbalances just keep growing. Think about a pressure cooker. You can keep the lid on, keep the pressure building for a while. But eventually, something has to give. Either you release the pressure in a controlled way, or it releases itself in an uncontrolled explosion. The precious metals markets are like that pressure cooker right now. The pressure is building. The fundamentals are screaming for higher prices. And the longer the paper market keeps prices artificially low, the more violent the eventual repricing is going to be. Here's another thing to consider. The people who are buying gold and silver right now, the central banks and the ultra-wealthy and the informed investors, they're not buying because they think prices are going to go up next week or next month. They're buying because they understand that precious metals are insurance. They're protection against systemic risk. They're a hedge against the kind of catastrophic scenarios that most people don't want to think about, but that are becoming increasingly possible.